has worked on the intersection of international economics and finance, looking at how firms operate in global markets, how they use credit, how they make decisions to innovate, and what their strategies are in terms of internationalization. And we're very happy that Veronica is today talking about bank credit and international trade. Very excited about that. Before we start, just a short note to all participants. We will first have 40 minutes of presentation by Veronica, and then we have 20 minutes Q&A. If you have any questions, please use the chat or the Q&A option that you can see below, and then I'll make sure I'll forward the questions to Veronica after her presentation. Yeah, so without further ado, very happy to have you, Veronica. The floor is yours.
Well, thank you, Casper, and thank you, the organizers, for having me here today. This is a great seminar series, so I'm very, very honored to be part of it. Let me share my presentation. I hope you can see it. Let me know if you cannot. So my talk today focuses on bank credit and its role in export activities. What I'm going to base most of my talk is on my own work, but I'm going to comment also on other results that have been established in different contexts that answer my very same empirical questions. So hopefully we'll have an idea of external validity of some of the things that I'm going to mention. So my talk is focused on three aspects in which credit shapes export activities. So, oops, this is a little bit weird. Okay, so can you see better now? So first I'm going to talk very briefly about an old literature on financial development as a source of comparative advantage. This is a long-term type of steady-state link between availability of credit in a given country and industrial development in the country across industries, with the corresponding effect on export. This goes back, if you want, to Schumpeter, where he already looks at financial intermediaries as essential for development and technological innovation. Then I'm going to look at the more short-run effect of credit on firm-level exports. So in this, I'm going to use more granular data. I'm going to show you a lot of results that I just finished using the same context and the same database, so we can observe different patterns using the same database that I have here in my computer. We'll be able to look at the sensitivity of exports to credit fluctuations, and based on that, try to infer the way firms use credit in their export activities and how we find credit frictions to be a problem behind, or a facilitator behind, firms' export and participation in export markets. And finally, I will mention an agenda I'm currently working on, which is on bank specialization into markets, and in particular, I'm going to talk about export markets. When we say markets, I'm not going to talk about banking sectors. I'm not going to talk about corporate markets, a corporate sector versus mortgages. I'm going to mean markets in which the firms operate, the firms that are related to these banks. So in here in particular, we're interested in trade. So I will show you some evidence that banks seem to develop a kind of expertise in lending towards different export destinations. So hopefully it will become a little bit more clear what I mean by this. So our first topic is going to be, as I said, financial development and the cross-country patterns of comparative advantage. So the idea behind this agenda is quite simple. Let me see if I can show this better. The countries have comparative advantage in those industries that intensively use and abundant input. So countries have comparative advantage in input in labor-intensive industries if the country is abundant in labor. That's a super old, and we are all familiar with that kind of trade intuition. There are some industries that might require more external capital, And in principle, these are industries that have large fixed assets. This is a seminal paper by Rajan Singales back in '98, where they compute using US data as a benchmark for what we can think is unconstrained firms, what is the industry-specific share of external capital, an idea of a technical need for external finance. And they look then at growth in an industry or country, say between 1970 and 1990, depending on what is the financial development of a country. Typically, we measure that as growth to GDP in 1970, and this idea of external dependence across industries. So, of course, they absorb industry fixed effect and country fixed effect to try to get that idea of comparative advantage in industry country. And the countries with better financial markets, credit to GDP, experience larger growth in those industries that intensively need funding. So we have this coefficient here being very positive. This intuition was taken to export data by Beck and Kalina Manova, where they see the same when they look at export share in a given industry and country. And they find that countries with better financial market have larger export shares in industries that intensively use credit. This was confirmed, is quite a robust fact. So the idea is very intuitive, and the link between financial development and industry composition is incredibly strong. But of course, as we know, this financial development index, credit to GDP, is not really an endowment. It's not really an invariant and exogenous characteristic of a country like temperature or soil or its geographical location. So how do we distinguish between the effect of lending condition on export from changes in financial markets in response to other factors affecting export? This is a crucial empirical challenge that is going to be a problem in all these research agenda, and I'll try to tackle later when I show you how we evolve this conversation using more granular data. So, for example, countries that are more financially developed are typically richer with more skilled labor, so it's difficult to disentangle the actual mechanism behind the export performance. Is it that exporting technological industries by a given country is better explained by access to financial markets or financial or funding in general, or is it coming from having a more skilled labor more generally? Or even if we look at higher frequency, short-term fluctuation in credit to GDP, well, any fluctuation in credit is associated with a lot of macroeconomic fluctuations like interest rate and exchange rates. So the relative price of export and imports and the relative price on tradables versus non-tradables are all affected. So how can we disentangle the effect of credit fluctuations on export from all these compounding factors that co-move with this credit variation? And then, of course, we have the usual reverse causality caveats, because financial development may itself be endogenous to industrial needs. For example, we can think of financial access allowed Chile to develop its mining industry, or might be that capital inflows entered Chile when its potential for copper was discovered. It's difficult to get that. And that reverse causality was very much explored by Do and Levchenko in the JFE 2007 paper, when they find a strong support for this alternative view. So to summarize, there's a strong link between financial development and the performance of capital-intensive sector, or sectors intensive in the usage of external finance, both in the cross-section of countries, but also when looking at time-varying fluctuations in credit to GDP. But given how difficult are the identification problems associated with this type of regression, it's hard to conclude on the mechanism and causality. So the literature kind of moved to the analysis of firm-specific fluctuations in credit supply. And that allows us to better identify this kind of mechanism, the way shocks to credit supply affect export performance by affected firms. But it came as a cost. Without a model specifically, just looking at the empirical results, we are missing general equilibrium effects. We are going to base a lot of our estimation in kind of diff and diff specification that abstract from these general equilibrium effects on long-term trends. So this takes us to the next point, which is I'm going to explain to you a lot of what I've been doing in this agenda, but always keeping in mind that I'm going to focus on firm level effects that are partial equilibrium based on this type of different specification without looking at how access to credit might have this general equilibrium long-term effects. So this takes us to the core of the talk, that is going to be about the computation sensitivity of firm export to credit fluctuation. And based on these results, I'm going to try to infer about the way firms use credit for export activity and hopefully get some policy implications associated with credit and the availability of credit for exporting firms. Throughout the entire presentation, I will use this data set that I have here in my computer, and I've been running some specifications to support the presentation today that is coming from Peru. So this data set combines firm level data on export, all the shipments to any product and any destination, with a credit registry in Peru. So I know how much credit and each and the currency denomination that each firm has with each bank in Peru. And I also have a lot of information about the banks, the balance sheet information on the banks. So I will repeatedly exploit a firm level credit supply shock that we identify in a paper joined with Daniel Paravicini, Philippe Schnabel, and Danny Wolfenson in 2013. And it corresponds to the time around the collapse of Lehman Brothers in July 2008. Basically, what we observe in the graph in the left here is capital inflows to the Peruvian banking sector 1 year before and 1 year after, this 1 year before and 1 year after the collapse on Lehman Brothers. The graph is common to, you will see a similar graph in most emerging markets. Peru had no direct exposure to the subprime mortgages. There's no banks in Peru that actually had any mortgages in the US in the balance sheet. But every time there's an international financial volatility, we tend to observe the similar patterns in emerging economies, this kind of flight to quality event. Peru was recipient of capital inflows up to this moment, and then we see a capital flow reversal, international flow reversal after July 2008. So what we are going to use here is how this capital flow reversal that was entering into Peru prior to the shock and then was leaving Peru afterwards affected the Peruvian banks differently. And for that, we looked at the share of dollar liability, how much these banks needed foreign funds for their activities across all banks in Peru. Here I'm showing the biggest 10, and in red, I'm showing the share of dollar liability for the banks above the average in the system. So as you see, we have some international banks, but also some local banks. In both places, we have Santander here, and at the same time, we have some local banks as well. So there's not a clear pattern, and we have different sizes, but these are all top 10 banks. We have different sizes, different combination of local and foreign banks, but differently affected by this reversal of capital flow. So in a nutshell, what I'm going to do is I'm going to call these banks in red exposed banks, banks that were exposed to this reversal of capital flow. So these banks having more dependence on these foreign portfolio flows had to cut credit relative to banks that were not so reliant on foreign portfolio flows and therefore did not suffer the reversal after 2008. So this is going to be the basis of our instrumental variable approach. What we do is we're going to analyze the effect of credit, lending, supply. So it's not just a correlation of credit and export, but it's going to be the effect of credit supply on exports. And we're going to instrument for credit supply at the firm level according to the share that each firm has of credit in an exposed bank. Importantly, we're going to absorb first firm, product, destination, and also destination, product, time fixed effect. Destination is the country of the export, product is an HS4 or HS6, depending on the specification. So in a nutshell, what we are doing is we are comparing firms exporting cotton shirts to the US, one borrowing from an exposed bank, another one borrowing from a non-exposed bank. So the idea is that the price of cotton, the input, equally affects both firms, or the price of shirts, the output, equally affects both firms, or changes in the demand for shirts in the US equally affects both firms. The difference is that they're differently affected by this credit supply shock. With this idea, we're going to be able to do the IV result, the instrumental variable result, looking at the elasticity, that is the effect of log of credit supply on log of export at the firm, destination, product level. And what we find is that this elasticity is 0.195. So 1% increase in credit supply results in 0.20% increase in export in the intensive margin. That is the volume of export for firms that continue exporting the same product and to the same destination during the entire period of analysis. We could also see that the 1% increase in credit supply results in lower probability of abandoning a product destination market, but it doesn't seem to affect the entry decision. In that short-term frequency kind of fluctuation, more credit is not increasing the likelihood that the firm starts exporting to a new product or to a new destination. We estimated a heterogeneous effect around different export-specific characteristics that are usually associated with the hypothesis of how is it that firms use credit in export. So we could say that at least with our data set, this elasticity here does not vary across industry depending the external financial dependence, that variable that Rajan Singhal is constructed. So we do not see the short-term fluctuation in credit affecting differently exports depending whether one firm is more or less depending on this external finance dependency measured in many, many different ways. We also do not see that the elasticity is larger for export towards more distant destination. The idea behind this hypothesis is that more distant destination takes longer and maybe more expensive to ship, and therefore the required working capital is larger. We do not find that the elasticity changes in this dimension, nor with the mode of transportation, air versus sea. So with this already, we can infer a lot about the usage of credit by the firms. First, we do not see, based on these characteristics here, that credit is used to funding export-specific dimension associated with this international shipment. We do not see a lot of results there. We also do not find a significant effect on entry. A lot of models like the one that that is probably best known is Thomas Chenet in 2006, point at the need of credit to pay entry costs of exporting. Well, this, at least in this type of short-term fluctuation, doesn't seem to be a relevant margin in our data. On the other hand, this sensitivity is quite high. So this points at the importance of credit for working capital. I cannot say whether the working capital is used in production, in general in all output, and therefore also in export, or is it specific to export? Not yet, at least with these results. But we can infer that there's a fixed cost of exporting, because this effect on the intensive margin translate into exit. So what means is, well, if you have a fixed cost of importing, when there's more availability of credit to sustain more output and export, it implies a lower probability of exit. And the other thing that we can say is that the fact that the intensive margin is so sensitive to credit fluctuation is important for aggregate effects. We know that in high frequency, most of aggregate effects in export are coming from the intensive margin, because new export flows are very small. They don't account for much of aggregate export. So the fact that we find these big results for the effect of credit on the intensive margin implies that cyclicality of export is in principle quite an important effect. Okay, the other thing we did, and I think this is quite important, is that we explore how the firms changed the term of their export contracts according to fluctuations in credit. So in a sense, this is following the work by Antros and Foley in the GP 2015. They analyzed in the cross-section of a poultry industry how export contracts change their payment conditions, letter of credit, cash, or with trade credit, what we call open account, according to the two different characteristics of the exporter. Using our data in Peru, we can try to see how the firms provide more, these are exporters, the ones that we are looking at, so they have the choice of either selling cash or selling with trade credit to the clients. And we can see that effect, we can see it here, when we have more, when these firms have access to more credit, they can sell more in credit, and therefore the percentage of their export that is contracted cash drops. This is important because the firms compete in export market through a variety of ways. It's not only through prices or quality. Prices is only one dimension of a high dimensional contract that includes the credit embedded in the contract. So when firms have more access to credit, they can offer better terms in the contract. This is something that Banu Demi, Mikalski, and Ors also find in their paper using data from Turkey. What they exploit in that paper is a change in the banking regulation that came with Basel II. Basically, Basel II implied a re-weighting of risk associated with the counterparties of letter of credit. In particular, letter of credit had now a risk weight that is associated, instead of with Basel I, with whether the country were in the OECD, the counterparty country was in the OECD or not in the OECD, now has a whole gradient depending on the sovereign risk of the country. For a lot of OECD countries, that implies that the risk weight increased. So that implies that banks now find it more expensive, they had to provision for more risk when issuing letters of credit. For non-OECD countries, or a lot of non-OECD countries, the risk weight decreased. That implied that banks find it cheaper to issue letters of credit towards trade flows in those countries. And what we observe in export from Turkey is that immediately the share of exports with letter of credit increase and decrease accordingly to that supply-driven change in the cost of letter of credit. So again, what we are saying is that the terms of the contract is highly elastic to the availability of credit and the cost of the credit in a loose way, because it includes letter of credit, that it's a financial instrument more generally. This is a way in which firms compete in international market, and this is yet another way in which having good financial sector translates into better terms for competing. And finally, I want to show another important financial instrument provided by banks, that is exchange rate financial instrument, FX financial instruments. We look at that mechanism in the case of Peru. If you recall, exposed banks, as I defined it, were those that rely on foreign funding, which was cut after Lehman Brothers collapse in 2008. And we find the elasticity of export to this supply shock to be quite high. It turns out that the drop in credit originated by this shock was entirely driven by dollar debt. If something, local currency denominated debt increased in soles. The overall debt to exporters, as instrumented the way they did, dropped 17% for exposed banks relative to non-exposed banks, but it was entirely driven by dollar-denominated debt. Unfortunately, all exports in Peru are invoiced in dollars, so we cannot see whether this affected separately exports in different currencies. In our data set, we see homogeneity in that response just because all exports in Peru are invoiced in dollars. But I want to quote here the work by Bethieux, Horny, and Messonnier, people from these researchers in the Bank of France. They have an identification strategy that is very similar to the one I described for our case, the one I presented using Peruvian data, but in their case, they use French data. They exploit a dollar funding shock that affected all the euro area in the summer of 2011. Basically, this was at the beginning of the euro debt crisis. The euro dollar market really dried up until the Fed and the ECB agreed on currency swap that provided liquidity into this market. So in the same way that I did, they defined bank exposure to this dollar funding shock as we do, banks with high share of dollar liabilities. They do not have the data on the currency denomination of loans, so I cannot basically do this exercise with their data. But what they can observe is that exposure to this shock affected credit only to exporters towards the US and did not affect significantly credit towards firms that export only to the European Union. They interpret this as evidence that probably the disconnected with the currency of the currency in which the loan is denominated. In any case, what they can observe is that this credit shock affected export differently in their case that went to the US and were invoiced in dollars relative to export that were going to any other destination. So what we can see is that banks really need access to dollar-denominated debt and dollar-denominated financial instruments when they are dealing with dollar risk. This is, I think, something that is worth going. It is worth further research, but it's an important thing to keep in mind. And central banks have this very much in the back of their minds, but because when it comes to liquidity and trade credit, they really put access to this type of mechanism for exporters at the top of the priorities. This is especially the case for emerging markets where you can have swings in the access to dollar-denominated debt in general, but you prioritize access to $2 for exporters. So let me summarize here where I think we can, what we can take out of the analysis of export sensitivity to credit supply shocks. So first, that exports are quite sensitive to credit supply fluctuations. The mechanism is not necessarily export specific, as at least in my data set. It might be that the effect goes through overall production. Access to cheaper working capital contributes to overall production and therefore also to export. But our results suggest that at the very least, we have fixed cost of exporting at the product destination level. So cheaper and abundant working capital results in lower exit probability. And we do not find much support for big entry sunk costs that require credit. So the other thing that I think we can conclude here is that although export sensitivity to credit does not seem to vary across usual industry country heterogeneous characteristics like distance or the type of industry, we do find that the terms of export contracts, which is really crucial for competing in international markets, is very much affected by the firm's credit condition. And finally, what I think we are learning more and more now is about the importance of access to these FX financial instrument for export activities. And on this, I want to call your attention to the research by Laura Alfaro, Kalani, and Varela, who are now working on FX hedging in Chile. They have an amazing data set. I am not quoting a lot here because it's still the results are preliminary, but very, very promising. And it now takes me to the final topic that I wanted to discuss here, which is what I'm currently working on, which is bank specialization in general, and in particular, bank specialization in export markets. This is a difficult object to define, so I want to start with a graph. Again, using my data set on Peru. So we have here is bank loan portfolio shares associated with two countries, the US and Switzerland. The US is signaled with the blue triangle, Switzerland with the red dot. These are averages of 1998 to 2010, and these are the biggest 14 banks in Peru. So what do I mean by loan shares associated with the country? Banks do not lend towards the country, banks lend to a firm, and we cannot know what is the activity associated with that loan. Money is fungible, so even if the firm tells you, I don't know. So the share of the loan to a firm is weighted by how much each firm exports to each destination. So in a sense, what we are defining as loans towards a country is loans, share of loans, weighted by how much the firm that receives that loan is exporting to the US or to Switzerland. So defined this way, we have, if we see the entire banking sector, the total share of loans that goes to firms that export to the US is very similar to the US weight in total exports, 20%. The same goes for Switzerland. The total amount of loans in the entire Peru banking sector that goes to firms that export to Switzerland is around 9%, which is really the share of export to Switzerland in Peruvian exports. However, if we see what happens in this plot, we see a lot of heterogeneity in these loan shares. And what is very important to us is we see a lot of outliers. So for example, concentrating Citibank here, this is an international bank. Although on average, most of the system share associated with Switzerland is around 9%, in the case of Citibank, we see almost 50%. And of course, as a counterpart, the share in the rest of the activities is much smaller. And we observe it here. For the US, this is way below the average in the system. We can see that the opposite is true, let's say, in Banco de Comercio. where in this case, Banco de Comercio has a lot of share of its loans that goes towards firms that export to the US, and as a counterpart, what goes towards Switzerland is smaller than average. So with this intrusion, what we did is we systematized this measure of loan shares by export destination across all countries and over time. And what we observed in that graph that I just showed you is really the rule, not the exception. Banks do not seem to hold a diversified market portfolio like our finance textbooks would predict. And actually we are replicating this with other type of economic activities and also geographies in France, in Italy, and this seems to be the norm. So banks are skewed towards certain activities and away from others. You cannot be specialized in everything. So, and what is interesting as well is that this is persistent. So what you have here is a transition matrix where we looked at these portfolio shares within country, whether a bank is in the first, second, third, and fourth quartile of a given country distribution. And what we observe is that the transition probability is very heavy on the diagonal, which basically says that over years, they tend to be specialized in the same countries. So, for example, in our recent example, Citibank is specialized in the US, so it's in the fourth quartile of the US specific distribution, but it's not for Switzerland. So for Switzerland, Citibank is in the first quartile of the distribution. Of course, this distribution might be just a funny feature of the data, and there's nothing to it. But we are testing the hypothesis that maybe there's something else. Maybe banks that have a lot of share of their lending associated to a country are just better in lending towards that country. They provide more financial services, they just understand that market better. So what we do is test that hypothesis. We do 3 kind of empirical tests that suggest the existence of lending advantage towards lending to a specific destination. The first thing we do is check whether the covariance between credit and export is larger when export is the country, when export goes to the country of specialization of the bank. For that, what we do is look at this beta here. So we are looking at the correlation between lending and exports, depending whether the country is a country of a specialization of the bank. We are absorbing all firm time fixed effects and bank time fixed effects. The results are here. And what we see is that within firm, when the firm tilts its exports to a given country, it also tilts the share of its lending towards banks that are specialized in that country. Our second test looks at the extensive margin, whether firms are more likely to start a banking relationship with a bank after they start exporting to a new country. And again, we look within firm. So if a firm enters a new destination in T-1, we want to observe whether they start borrowing from a new bank, depending on whether this bank is specialized on the country they just entered. And what we see is, again, in the benchmark, which is a non-specialized bank, this probability is actually lower, but it increases to very positive for banks that are in the quarter, in the very specialized quartile. And finally, in our third test, we look at a pure demand-driven change in export. We instrument changes in exports toward a country C with a GDP growth and real exchange rate between that country C and Peru. And this result is shown in this IV regression here. So a positive increase in demand for export increases credit demand across all banks, but 50% more. Remember that these are additive effects towards the base, relative to the baseline. It increases 50% more for banks that are in the top 50% of the specialization measure. So overall, these results basically say that portfolio shares are not just random. They really are a signal that are of an underlying lending advantage. Banks specialize in lending towards the US are preferred when the US increases demand for Peruvian products, and also when firms start exporting to the US. That's the idea. And let me conclude with the final thing we do, which is we revisit again that credit supply shock I've been using throughout the entire presentation, and look again at the effect of credit supply shock on exports. This is the number I presented before. This is the elasticity of credit supply on export. But now I am looking at this effect separate depending on whether the bank that suffered the shock is in each of the quartiles of the specialization relative to the country that I'm observing export. And what we see is that, yes, credit supply affects export, but that result is entirely driven by specialized banks. So intuitively, the effect of credit supply of export is entirely driven by a specialized bank. When Citibank reduces credit supply, exports to Switzerland are the ones that are going to be affected. So just to conclude on this topic of specialization, we think that banks play a role in the pattern of comparative advantage that goes beyond just providing funds. They seem to develop expertise in the activities of the firm. We do not know what this expertise is coming from. It could be that they're just better in assessing a project or collateral, or they provide better in terms of the loan, or that they provide export activities associated with the destination, letters of credit or FX hedging. In all cases, this expertise makes bank less substitutable, and therefore it has effects in terms of propagation of shocks. It might be that shocks to an isolated bank end up having disproportionately effect in some activities, or shock to a given activity end up having a disproportionate effect for some banks. Because expertise is a force against diversification of portfolios, so they make them a little bit more susceptible to shocks. This reinforcing effect is something that we look in a recent paper with Fadi Hassan and Stefano Federico. So I want to leave it here because I'm already out of time. Basically, I concluded my big three topics, and I want to thank you again for the invitation.
Yeah, thank you so much, Veronica, for this very stimulating talk. I think it raises a lot of interesting thoughts and questions, probably. I don't see any questions yet from the audience, but I'm going to look at the co-organizers. So Beata, you have a question.
Yes, thank you very much for a very nice talk, Veronica. A quick comment on Rajan Zingales index, right, versus short-term shocks, right? I mean, fundamentally, Rajan and Zingales index is about the need for external financing to cover investment in intangibles or in developing new technologies and so on. And therefore, it's not surprising that people find it as a determinant of comparative advantage, but that you don't see that it matters in your exercise. With Mathieu Crozet and Banu Demir, we developed a product-specific index of dependence on letters of credit, right, which are trade finance instruments. And there also we see, for instance, very little correlation with Rajan and Zingales index, because I think fundamentally this index captures something else, and it's not suitable for considerations of short-term fluctuations.
I agree with you 100%. You know I am on you on this. I want to add that one thing is conceptual. As you say, they go after different usages of credit. In one case, the usage of credit might be fixed investment, much longer term. In the other case, we are short-term fluctuation have a very large impact because it probably goes through working capital. You are talking about letters of credit that is also very short term. I go beyond that because a lot of what we observe is not associated with letter of credit, it's just short-term working capital, open accounts in banks, revolving lines, and so forth. But also when we look at, if we want to see this longer term type of development, we are forced to looking at cross-sectional, cross-industry analysis. And from a practical point of view, from a point of view of a researcher, it's just very difficult to identify. This cross-country, cross-industry analysis, I wish they worked, but they're just very difficult to identify empirically. So it is also a practical challenge on how to derive convincing results out of it.
Thank you.
Catherine, you have a question, I think.
Yes, I think perhaps it's just asking you to speculate a little bit about things that are very difficult to see, but I think a lot of what you have in the sort of approach to identification is that these relationships that exist before the shock are exogenous to the response to the shock. And yet, when you look at that list of banks, or say Peruvian banks, some of those names are familiar, they're international banks, they're very different to local banks. And this notion of banks having expertise, I mean, is there a way to look at the network of international banks and see how that expertise develops? And is that research that's possible? And then secondly, sorry, and related, the firms that are selecting into getting credit to export from either local banks or international banks, do you have a sense that they have exhausted other sources of credit, such as what's available within their business group or within a multinational setting, or I don't know, from some government support or things like this? And are you worried about those two kinds of selection?
So we did look at the network of international banks in some cases. So for example, for international banks, not all the banks in Peru, not even the largest, are international. But for international banks, we collected information on the network of subsidiaries. And we tried to see whether the pattern of specialization has something to do with the network of subsidiaries, whether so in a sense, whether a bank has expertise in a particular country is associated with having an affiliate in that particular country. We did not see that. So we do see that international banks are good for exporting. We did not see a pattern coming out of the network of subsidiaries. That was actually funny you mentioned, that was what we were after. So we were very disappointed not to find it. We also see a lot of differential effects for multinational firms. So multinational firms multinational firms are not very much affected by what I'm saying, because multinational firms did not suffer a cut in credit during the time. So when I look at the instrument for the way banks received a shock and they transmitted to firms, it looks like they transmitted to all firms, but not to multinationals. So multinationals, they might have access to additional sources of credit, they didn't need it because they were not rationed away. So probably there's a pecking order for the banks at the time of cutting credit. Turns out that multinationals were kind of nicely isolated from the effect. I did talk with people from different regulators in Latin America of what happened around that time. Turns out that this shock in the subprime crisis was kind of different from others, in that it originated in the US, and the US and Europe were more affected than emerging markets. So a lot of firms that are really good, multinational firms that usually have credit coming from the US and Europe, they ended up going back to Peru and crowding out smaller firms. So, so the credit in Peru was very much cut for smaller guys, not so much for larger banks that basically, for larger firms that are really big, had access to credit and crowded out the other ones. So we have a little bit of that happening.
So I don't see any questions from the audience yet. So maybe I can take this opportunity to ask you one. I really like the last bit of your talk about the banking specialization. I wanted to ask if you can speculate as well a bit about this. So it seems that banks really focus on specific sectors. Would you say there's some kind of monopoly there, right? So in international trade, we talk about markups, how multinationals mark up prices in product markets, wages in labor markets. Is this something you could see here as well? You are mentioning exactly what I'm trying to go after right now. So I'm trying to come up with a way of getting markups in lending markets, in banking industry, and see whether they have something to do with this type of specialization. By the way, what we are looking at is not only, I presented this being a trade audience, I presented the specialization in export market, but we are observing this type of specialization in other dimensions as well. So it looks like banks, for example, we look at France, and France is specialized, lending in France is also quite specialized in some geographical areas and not others. And we talk with some people at the Fed, and they look at banks and they see that in consumer finance, they seem to be specialized in some demographics and others. So there seems to be some expertise here. We're still trying to understand where it comes from and what does it imply for a regulator, where it implies market power, where it implies lack of substitutability, where it implies some activities or some households in the case of consumer finance to be a little bit unprotected. So we still are far from understanding this. So we are going in that direction, hopefully. Okay, thanks. I don't know if there are any other questions. I have one, but it's a very broad question. Also, again, maybe a bit speculating. If we look at lower income countries, we tend to tell them or promote that they do export-led growth. And there are a few papers showing, if you want to export, and as you also show, you need these financial institutions, which are very often lacking in these situations. I just wonder if you could say a few things about this, like how does this work when we tell countries how to do this export-led growth?
So what I feel more and more is that access to credit is not something that is specific to exports. So export is just the last step after so many things that a firm managed to accomplish. So export is needed throughout. And now there's some financial instruments that are specific to exports. So, and that is relatively easy to help them with. So FX hedging, letters of credit, some kind of guarantee, being sure that when a country is run, I'm coming from Argentina, so it's very often that even the counterpart of a letter of credit is not guaranteed when a country has a crisis. So that type of thing are things that a good system of guarantees can provide. Now, making a firm able to export is not just about that last step. They need to make it all the way up to there, and that requires something that is more general than just the specificities of export.
Okay, thanks. I see we're almost out of time. There's one question from the audience. So Laszlo Halpern, I hope I pronounced as well, is asking, would the analysis of importing add anything to the understanding of specialization pattern?
Yes, it would. The reason why we find it difficult is that we're all the time controlling for product destination time in our regressions. What I mean by that is that it's very easy to control for demand at the product destination using export data, but it's not so easy to control for demand of the product. I mean, not of credit, of the product when we use imports. This is probably something coming from the data. In our Peruvian data, we only observe export and imports, and we do not observe the ultimate industry of the firm when it's just an importing firm. So it's hard for me to control for demand of the product when I only observe inputs. In other data sets, I'm sure this is not a problem and a lot more can be done.
Okay, maybe I can squeeze in one last question. Camilo Rivera is asking, what is your main policy recommendation regarding the role of government import-export banks as export facilitators based on your results?
So actually, I think a lot, I think I'm going to go against my own results, but I think a lot can be done that is not just credit. So I think in terms of credit, as I said, there's a lot of guarantees and sometimes banks do provide guarantees for export, for trade credit and trade finance. So it's trade associated with having an export or an import order. So that is something that definitely is very easy to implement and it could be there. But in general, importing and exporting, especially exporting, is a lot more than credit. It's having presence in international fairs, is learning about the quality requirements of the place they're going, is trying to come up with better terms of access to markets, free trade agreement. These are much more first order than just exporting. And that just trade is specific for exporting. As I said, I'm not credit is specific for exporting. As I say, I'm not saying that credit doesn't matter. Credit matters a lot for the whole production process. It's just not only for that last step of exporting.
Okay, thank you very much. So Veronica, thank you so much for this interesting talk. It was really a pleasure to have you here today. Thank you to the audience for participating in the questions. And yeah, we hope to see you soon at the next seminar. Thank you.
Well, thanks a lot for having me here again.
Thank you, Veronica.